Good to go?
Yes, we are. We are now live. So, thank you everyone that is just joining in. No music and no intro stuff for today because we have kind of a packed session here. Joining me today, we're actually not going to be talking about specific stocks as we usually do, but we definitely can discuss different things that are going on in the market. I hope and pray that a lot of you guys have not been stuck into GameStop today. GameStop itself falling. Let me just check the after hours right here. GameStop is actually down 60% and is actually down 3.33% after hours. Brutal day for anyone that's still invested in it. I definitely hope and pray that you guys only bought maybe like one share because that's a significant loss. And if you did lose some, I really hope it wasn't all your life savings and everything like that. But that being said, just discussing about investments and life savings and things like that. I have a very special guest today with me today. This is kind of a bit of experimental. We'll try to bring on more guests every so often. Let me just introduce you guys to Brandon Benzon. So Brandon, let me just throw you in the screen here. If you can just introduce yourself to everybody and just, floor is yours.
Awesome. Well, a pleasure to be here and a pleasure to have everyone on. A pleasure. So, just to introduce myself, hi guys, my name is Brandon Benzon. I've been a financial advisor, more of a consultant in the financial literacy space for my company, Unbreakable Financial Solutions. I've been doing this for close to about 7 years, going on 8. My story in this background was just that I didn't want to become an advisor, just happened by chance after just some career change when I was in university. So really just what really motivated me to get into this industry was just seeing how much of my own friends and family, weren't really given the proper education to manage their money. In fact, it felt like they were being sold another product they didn't really need. And what's really more eye-opening is how I saw a close friend of mine's got affected by this sort of effect. And what happened was that he had over $87,000 of his life savings. He trusted an advisor that worked at the bank, and what happened was that he wasn't getting the returns that he wanted actually, and his investments dropped from 87 to 85, and the person that was handling the account actually left to another branch itself. And that's what really motivated me to get my license in order and learn just basic things to really help the people that I'm helping right now, whether it be just helping in areas such as saving for my clients' education for their kids, specific things like for retirement, for their house, or even more meaningful things. Whereas one of my clients has a relative that recently just passed away with both like husband and wife, and now they're trying to save up a trust fund for their orphan child for whatever they need for their education and so forth. And it led to other opportunities such as speaking at York University for a bunch of their Filipino clubs, doing seminars through there. And most recently, a huge seminar and last Sunday, just educating university students across Ontario the basis of financial literacy. So this business is something that's very near and dear to my heart because I know how much it could really just giving the power of education, especially with investing and overall financial planning, can really make a difference in people's futures. So that's why I kind of stuck with it.
No, that's amazing stuff. I mean, there's a lot behind. I know. I'll just full disclosure for everybody that's watching. I do know Brennan myself personally. I will just put a little disclaimer out there for anybody that's watching as well. We are not dishing out official financial advice here, although Brandon is a financial advisor. So if you ever need stuff, you can always go with him. There's a bit of paperwork to do, but of course, in that capacity, we're just doing a discussion. All of these are just opinions and observations as of right now. And myself, and on behalf of Nest, we're not officially endorsing anything at this time. But disclaimer aside, I do know Brandon from networking events. I do know that a lot of people, before the pandemic, obviously, we were able to kind of go out there, discuss with different business owners and everything like that about things that are going on. And then, of course, connect with different people because there are people that are not very financially literate with everything, and they do need somebody to advise them on, different little aspects on what the market is, and they don't have maybe the time or they don't have the ability to particularly manage a portfolio or even understand what stocks are and everything. So it's usually Brandon's job to advise them once they've signed up with him in regards to a lot of different things. And we're actually going to get into a few of the different subjects here that Brendan has thankfully prepared for and everything like that. Basically, I guess, one of the main things that you do is help provide some long-term planning and goals. So if you can just kind of give an overview of like, what does that mean? Like, to why should I plan for the long term, and what kind of goals would somebody be looking at if they are trying to get into the markets or investments and use your advice?
Because for me, the majority of portfolios that I usually stick with is a blend between ETFs and like mutual funds. So I think that apart like for people that just do their like own DIY and they want to play the market, like there's nothing wrong with that. But there's such like a fluctuation and such a volatility, especially what's happening with GameStop. Nothing really beats in terms of just having a strategy, a plan, and just thinking about those goals. Between the difference of just like saving it in terms of your bank account or a GIC, or just be able to leverage healthy returns and long-term projection to reach that 5-year, 10-year, or 20-year goal. And and everybody's goal is different, right? Because like out of the clientele that I currently have watch over, some of these accounts, they're meant for their kids' education, and some of their kids are probably like around 2 years old, so they're thinking about like maybe 16 years down the road, they're going to have money for their education to use for schooling rather than just using OSAP to fund for their education. Or some of my clients right now are thinking a little bit more short term, like that one of my clients recently just got married as well, and in a year he wants to be able to save up for a fund for the wedding for both him and his future wife, right? And it really boils down of what your goals in terms of things to really have and certain milestones of life to be able to be prepared for rather than unprepared for, and having a realistic time frame towards it. Being able to identify if it's in 0 to 5 years, 5 to 10 years, 10 to 15 years, whatever it is you're trying to accomplish. I mean, there is a possibility to actually accomplish whatever, like all the goals that are necessary, but just making sure that you use the right type of plan, the right type of accounts, and the right type of investments that work with you, to be able to reach that XYZ goal.
So I guess one thing to actually talk about that you just brought up, which is very interesting, is the idea of mutual funds. So for people that aren't used to, because a lot of people just hear stocks and like GameStop. Now they might think that GameStop is a mutual fund, but if you can just explain a little bit about the difference between a stock and what mutual funds actually are.
With individual stocks, the key thing is just that like you're basically just buying the individual stock or the actual piece of the company itself, right? So meaning the fact that it is high risk, high return as well, because you're taking the full liability. The difference with mutual funds is just that imagine just having a portfolio of different stocks into one fund, right? Whereas an average mutual fund holds between 100 to 150 different types of stocks. I treat it like the fruit smoothie of investments, right? Kind of like how you have fruit smoothies and you have like different types of ingredients in that one smoothie. Per mutual fund, it could have certain investments into different industries, something into like health, something into consumers, something into finance, something into real estate, and it has little pieces of it to make that one portfolio. And the beauty of having them, some people may agree with them, some people may not necessarily disagree with them in overall, but the beauty of having them is just that they're very easy to really use, because behind the scenes, there's actually a portfolio manager that's actually managing, like that they choosing the actual stock picking themselves and doing the research for you in that certain sense. And the beauty of it is that you can have as many as you want in your TFSA and RSP. But the healthy recommendation, from my personal opinion, is of at least minimum of 4 and max of 6 at least, just to be able to not over diversify and not necessarily flood your overall investment portfolio. That's the pro side of it. The con side of it is just that there is a fee to typically manage each and every single year, something called a management expense ratio. Sometimes as a very low as like 0.5% to even like 2 to 3%, right? And that basically cuts out from the person's overall long-term return, right? And people may think this is like, oh, I have to pay a fee for my money, but it really depends. If you're really paying for per premium price, you should get premium experience. And as long as like your returns are at least outweigh the current fee that you're paying for long term within that 10 years, I mean, think of it this way: if you had a 2% like a MER that you have to pay for each and every single year, wouldn't you be happy if you had like a 10 or like 20% to be able to outweigh the current fee itself? So therefore, if you're paying premium price, you should be getting premium experience, right? So it really depends on how people see that. If they really want that ease of time and making sure that everything is done on automatic, and mutual funds are really great for someone that's more a beginner investor and something that wants more automated, in my personal opinion.
And I assume that fee is after you sell, correct? It's not just every single like month or something that you're going to charge you this.
No, not necessarily so. Because like that's totally it's basically that fee. It's not necessarily going towards me. It's going towards the operating expense to actually manage the fund itself, right? And there's other fees that are obviously associated with mutual funds in terms of the time of withdrawal. But for me personally, when I deal with my clients, I'd be able to just choose something that's ethical where they don't have to pay each and every single time for them to withdraw their money. Just making sure that I still get my commission out of it just by watching over the portfolio that I currently have for the firms that I represent through, and making sure that they have an ease of mind that, one, they have a portfolio that's working for them, two, it's not costing them too much.
And I would have to say too, it's you know, for people that are kind of wondering, it's like, you know, if you can, I guess, tell people what's the difference between you and, let's say, just going to Wolf of Wall Street stockbrokers and stuff like that.
So with the Wolf of Wall Street stockbroker is that instead of just trying to shove down products down your throat, I'm more holistic, right? Because apart from just looking at someone's investments, you know, I come in handy with other areas too, especially with the software that actually provides actual financial planning. Like, is in specific areas where it's not always just about investments. There's situations where I've helped people be able to create a plan to eliminate their debt in case they have 5 or 10 different types of credit cards, or they want to see a realistic pace to see, like, what would it really take for me to pay off, like, my student debt and so forth, right? And I find that apart from, as much as I love investments and something that I have, like, most business in itself, you know, it's really providing that education and me holding that person's hand. Because obviously, you know, they could do this research all themselves, because the internet is, you could do a lot of, like, research and be able to say, like, oh, I'll learn how to eliminate that. I'll learn how to do my own investments. I'll learn how to do my own insurance. But not many people can afford the time. So it really be that certain middleman to say, you know, I'll hold your hand. I'll be able to identify what goals that you want in terms of either eliminating your debt, saving and investing, or even a proper life insurance plan itself. Depends on what they want, and making sure that we work this in a simple holistic approach, rather than, you know, today you should buy, like, GameStop stock, and especially what's going on right now, right? So I stick in terms of the client's needs and be able to deliver the best solution possible.
Yeah, I can definitely say from personal experience as well. It's you know, if you do happen to be trading, or you do happen to be watching investments, doesn't even mean you are actually trading. It is a full-time thing, or at least you have to dedicate your mornings to it. You got to be prepared for it. You got to know what you're specifically doing. The nice thing about, as you mentioned, mutual funds is that you have you know, a whole breadth of different things that have already been kind of researched. Usually they're packaged in some sort of logical package. Like, some might just be U.S. stocks, some might be about energy, basic materials, that stuff, like you know, like wood and metal and, like, building materials.
They've gotten really interesting. I know that with Fidelity, they have something called a Women Leadership Fund, actually.
Really?
Yeah.
I'd actually be very interested to see the portfolio performance of that. So I'm just I mean, I'm not opposed to, not advice, but I'm not opposed to putting some money in there, perhaps, just to see.
Just to see. It's out there. I'll send you, like, I'll bring it up another time too. But yeah, it's interesting the way that the mutual. I mean, it's been around for quite some time. Like you see the traditional banks that have been around for, like, decades, served firms like the 1950s and the 1960s. So, you know, in terms, I know that, like, I could have, like, my dip my toes in the water, just do my individual trading and choose my own stock. But for me, I'm always the person just, like, set it, forget it, and let it automate, right? If it's doing well so far for someone like myself and my current clients, you know, why should I not necessarily try to fix something that's not broken, right? In that certain sense.
Exactly. And I actually just threw up the Women's Fund. Since its inception on the 3rd of May 2019, it's increased 35%, 36 almost, and the little dip from March 20th, it's went up 78%. I mean, that's a bit cheating, but yeah, since its inception, yeah, it is up 35.8%. So very interesting to see stuff like that, and I guess in terms of, like, long-term planning, what would you usually say is like is it prudent? Like, I guess the big thing is like, I know that you guys as financial advisors usually go in and you ask people about risk. Can you just tell people a little bit about, you know, why you guys ask about risk, and what does this have to do with planning?
Risk is no different of trying to choose the right shoes to fit into, right? Because you have to understand in terms of the right fit, right? Because the categories for risk, it is, especially this goes in towards my licensing, something called Know Your Client, KYC. It's very important to really assess the client's risk. It's just to understand what level of risk they can really take. Either the fact that they're very either low, they're medium, there's something called a little just above medium, a little bit more growth, or really more aggressive, right? And in terms of how, a common question that I typically ask for like a client that's looking to invest is just like, if you saw your $1,000 drop down to $500 overnight, like what would that make you feel at night when you sleep? Like, are you getting nightmares? You're not gonna care about it, right? And like when they elaborate that certain question for them, then they're like, if they're very sensitive, just like, oh, I'll be pretty worried. Oh, I'd be kind of like, maybe. Then they're kind of more of like low to medium. But versus the fact that they don't really care, just like a more like high risk, high reward. I have a couple clients that are like that right now. Then yeah, they're obviously more aggressive, and that really boils down to the characteristics. How it really boiled down in terms of weighting your portfolio with other mutual funds and ETFs specifically is the portion of stocks and bonds that you typically hold. And the best ways that my language of describing stocks and bonds is just that stocks are meant for the sake of growth. I like to call it like the harvest of the financial world, right? So like kind of like if you have seeds and you're being able to harvest them to be able to grow into more stuff, right? So stocks are considered the harvest of the financial world itself. Bonds are more preservation. They're called the fringe of the financial world, right? So something a little bit more safer. It doesn't necessarily, not too crazy in terms of growth, but it's a good way to preserve wealth, right? So in terms of someone that's very low risk, very simple, 50-50, easy, right? Someone that's basically a little bit more medium, 65% or 60% in towards more growth, and then the other 35 or 40%, depending on how they feel, more towards bond and preservation, right? And then it basically gradually increases to the point, if they're basically like high gunning and they're basically high risk, all of it is potentially to stock. It really weighs down on how they handle risk. Obviously, things change throughout the whole entire like year. Maybe they really done their research. They feel more comfortable with fluctuations after working with it for a while. They want to find something a little bit more aggressive or something a little bit more up their current risk tolerance, and then be able to provide that solution. But it's really important, even on a compliance standard, even just dealing with the current client that I basically deal with, either current or like brand new, just to understand what can you really handle and like what are you comfortable with, and making sure that we stick in terms of that agreement.
Yeah, and definitely. I'll just use the Women's Leadership Fund, not that I'm particularly endorsing it or anything like that, but they also, on Fidelity, do have a risk classification. It is actually classified as medium risk.
Yeah.
I do know when I took those New Year client applications, I usually raised a few eyebrows at the very end when people saw that I'm in the high risk, like off the charts. Like I really don't care. Like I shouldn't say I don't care, but it's like I usually realize the potential, and knowing that I don't need that money right away, I think is a huge aspect behind investing. Like if you need this money for your rent or you need to pay off your credit cards, definitely you should never do that, but there are people that do that, and that would definitely be considered high risk. There is a chance of reward, but at the same time, I mean, if it's your last $900 and you got to pay it for rent and you throw it out there, and you could take a $300 hit versus myself. I don't mind taking like a 30% hit on something, because sometimes I just know long-term growth, it's going to be fine, or I just don't need that money. So I think that's a little bit of an example of risk, and especially too when it comes to the funds that mostly people are providing too. It's like, are you comfortable seeing your money technically dissipate? I mean, you still own those assets. I think a lot of people get very confused by that. I remember when Elon Musk tweeted out Tesla's stock is too high, and then I saw the replies and everyone was telling him like, oh, you made me lose like all this money, and I'm thinking, they didn't really lose it unless you sold it. You lose the money when you sell. Not that I'm saying that you had to hold Tesla or anything, but at the same time, if you know something's going to grow into something much larger later on and you sell, well, now you've taken a loss versus, somebody that's high risk that, held on to Tesla since March. I mean, Tesla's increased, let me just bring that one up. Tesla since March has basically went up 870%. But if you sold during that time, from February to March at somewhere around there, you've lost 59% of your portfolio instead of holding, where you gain like 800 to 1,000%. So I think a lot of people kind of get confused by that too when they're dealing with risk and going into the portfolios and kind of understanding how stocks work, because I know a lot of times like they don't want to ever see a negative number. Nobody wants to see a negative number, but
Nobody does.
it's gonna happen. And even on the safe ones, yeah, they might be down like 1% instead of down like 15. But it's I feel like, do you get a lot of clients that are worried and they're calling you up and being like, what the hell, like let me out?
Surprisingly, when pandemic started and things started to drop down, only out of the 50 to 70 that I really managed, one of them. And the rest, they knew because I prepared them before. Like I always give them examples, always give them updates in regards to what's going on, right? And making sure that the returns are healthy enough that one client maybe with like 20%, and I always tell them, it's just like, yeah, the market's always gonna fluctuate, but what would you fluctuate in terms of your actual returns since inception? Would you rather fluctuate at 5 or would you rather fluctuate at 20? Right? Because if you take a 3% hit and your return's basically at 5, you're basically down to 2. If you take a 3% hit and you're basically at 20%, you're still 17.
Mm-hmm.
So basically, it depends. Like for me personally, not a lot of like people saying like, Brandon, what's going on with my money, so forth and so forth. It's just making sure that I give it enough education to know like what to expect in the future and just be able to not worry, just keep doing what they gotta do.
I think, yeah, that's definitely an important factor, and I hate overquoting Warren Buffett because everyone always uses him and stuff, yeah. but it's a perfect quote for him when he said to be fearful when others are greedy and be greedy when others are fearful. I know during the pandemic, I think I started increasing the amount of money that actually was being invested into the market. And there were some really good returns on that. I luckily was able to get out in February. I felt something was coming on, and then I moved back in on March, and a lot of people are like, "Are you kidding? Like the world's shut down." I'm like, "Yeah, but it's going to open up." There's things that are necessary to exist. So I know it's. I think it's kind of also too, out of sight, out of mind for some people if they're using an advisor, and they at least know that it's distributed. It's not all just all in one. I'm not putting like $10,000 into GameStop or something like that and then just letting it roll. Because I've seen there's a lot of posts on that. And I'm looking at like a few posts of earlier today, and a lot of people are like, still hold. And I'm like, you're down like 75% of your portfolio. My God, like. It's that's not, I wouldn't say that's prudent investing. I wouldn't even really say it's investing. That is much more on gambling. I know a lot of people want to stick it to the hedge funds, but at the same time, it's like, it's not what you provide. You're not there to, stick it to hedge funds. You're there to provide somebody with some long-term planning. And that being said, like what are like, when people are coming to you, and what sort of goals, I guess, are they trying to achieve usually? Or is there any goals that people should usually look to achieve more? Like, I know a lot of people might go to you and say, oh, I want to buy a boat in 5 years, or, live in a penthouse in top of New York or something like that. But like the actual realistic goals, what are most of the ones that people are trying to achieve?
Most house, retirement, education, wedding, a legacy for their family specifically. The most meaningful one that I mentioned is a trust fund for one of my clients that is has like now like dealing with an orphan child who needs that money for the case he wants to like move out of like Sri Lanka, and specifically like for school. Mm-hmm. So those are the common ones that I've been getting so far, right? Like nothing too crazy, just say like, yeah, I want to go buy Mars. It's just like, no, like you gotta be realistic for a little bit. So those are the common things that like common basic goals I really deal with. And more importantly, just being able to really just create a simple plan for them to understand, to make sure this is what it's going to look like 5, 10, 20 years down the road, depending on what goal you want between saving for a house or towards retirement.
Yeah, no, right? I think, just on par with basically what's going on today. I don't know if you heard, because they just did the earnings call for Amazon. And I think this is kind of a relevant example, but basically Amazon did $100 billion from the pandemic. They're increasing, and in case, like I said, you might not know, but Jeff Bezos resigned as CEO. So
really,
yes, that just happened during, I guess, the earnings call here. I'm getting a lot of news from that. But that being said, I think using Jeff Bezos as a very timely example right now of having goals is, if you do invest, and in his case, yes, he ran his own company, but at least he invested in something, which was himself. Becoming one of the world's, I think, a second richest man now, but and having a successful company, it's racking in $100 billion, and controversy aside, I think that's kind of actually good example of having goals, and the people that invested in him too. Obviously, you reap the rewards, and when you want to get to a certain point, as you said, some people want weddings, some people want education, trust funds, and stuff like that. It takes a few years. I feel like a lot of people, when they talk to you, they think that you're just going to net them like millions of dollars because you're in the stock market, and they see all the green and the red candles, and they're like, yeah, no, I'm like gonna be super rich super fast. Like, do you usually have to like temper those goals and expectations a little bit?
Yeah, I do. In regards, because like obviously, if for them to reach $1 million in like 5 years, that's like a good chunk of their income, or a lot more than they have to spend too. But it all depends. But there's certain ways to really go about that. There's actually a movement that's going on in terms of financial literacy, something called the FIRE movement. And it's basically an acronym for Financial Independence, Retire Early, where it basically just mentions in terms of just finding ways to really just increase your income. So there's been a lot of people that have been doing a lot of side hustles now just to just increase their income, maybe people taking like extra jobs and so forth, and budging whatever that they can save them towards like retirement themselves, right? but with the tools and softwares that I usually deal with to show them what it would really take to retire between the ages of 65 to like 40, especially for like my young professional clients, it just paints a picture that like obviously the shorter the goal in terms of like retiring by age 40, a lot more money you have to definitely chunk away on a monthly or even a lump sum basis versus just deferring it to like your 50s and 60s, right? So that's where I have to get really real with them to understand that like I'm not I'm not Lotto 649 for a financial future. I work a game plan and I work a system.
Yeah, no, that makes 100% a lot of sense, because I think with the stock market so hot, I admittedly, yes, I do manage some of my own investments. That's how I'm able to do these kind of shows and things like that. But at the same time, I do have somebody managing a mutual fund and portfolio, because it's a way to basically manage the risk. Because if I screw up, at least there's somebody else that had much better planning than I did. And it's as well, that's money I'm not supposed to touch. I'm not supposed to move it around. It's invested in portfolios that I like and everything like that. But at the same time, I think a lot of people, some people, there's a lot, like people with the advent of Robinhood, which is going through its controversy, and then you have Wealthsimple here in Canada. I think too many people are deciding to just immediately rush into the market itself without understanding it versus
I do have like Wealthsimple's a really great app. Like I like the movement that they have in terms of just empowering, like especially like our current generation, the millennial generation, to empower that it is possible to invest for less. But sometimes you have to really go underlying, like sometimes what I usually say for people, sometimes with like you're paying less fees, but sometimes no fee means no help.
Yeah.
You're obviously for beginner, for someone that thinking to themselves that they're the quote unquote guru per se, that you may like, I might buy this certain like hot topic right now, but what about actual principles? What about actually analyzing the certain stock in terms of financial, how long they've been around, are they green, and so forth, right? And people think to themselves just like, but I can use the app and it's really automated. But sometimes maybe you might need that diversified portfolio to start off first, and then as you get more comfortable, be able to set money aside for yourself. Even for my current clients, like I was their first choice to be able to start with investments, and then as they got a little more comfortable, as I handle with like their investments, that's when they started to feel a little bit more comfortable towards like using the apps in like Wealthsimple and Questrade, which is like some of my clients right now.
Oh yeah, I think that's the most important thing too. It's like a lot of people are just, they think that they understand the stock market, and the wonderful thing about the stock market is that it's so dynamic. I mean, people might hate this. I mean, it's as you said, there are a lot of gurus out there, a lot of people that have solutions, and some of the solutions will work temporarily, but there's a reason why nobody's like owning, basically the entire market. It's because they don't last. These solutions don't scale.
They don't.
You have issues too. Like if you were to make, I think it's 1 or 2% every single day, I think within about like 5 years you would own the planet Earth and Mars as well, all the way to Mars.
Yeah, like, and you hear like across like these certain commercials too, just but sometimes it's just like a ruse, like buy my course type of thing, right? So
Yeah, 1 to 2%. They don't take in the fact that you can be negative some days. It's not always.
it's impossible, and that's another thing to really address is just that nothing's really guaranteed in the marketplace. Everything is really proven, and everything has its track record. You know, the best way I described like the market itself, it's sort of like Toronto weather. Sometimes it's gonna be the long haul of our weathers, but you know, for the most part, there's gonna be like the bliss of our summertime as well, in terms of like in terms of ups and downs in the marketplace.
Oh yeah, and you can basically bet and gamble on almost anything, like seasons. I know, like futures contracts, stuff like that. Not that we're getting into that, but at the same time, I think a lot of people, you know, get into that. And I just would, just in regards to the esports, I know like esports stocks that I would have been invested into a long time ago. I didn't realize this, but one of the mutual funds that I had actually was through AMD, had AMD and Take-Two Interactive, and that was like 2 years ago, and those things have rocketed off. So I think the return on that mutual fund, and admittedly, I haven't checked my stats, but admittedly, it's probably better. I think it's 40% return on the mutual funds that I have right now. So that, I think that's one thing that, again, people aren't putting into effect. It's like people might just be like, oh, 40%, I could do that in one day. It's like, well, yeah, I mean, yeah, you could do 40% in one day. I think the highest I ever did in one trade in a day, like within half an hour, was 30%. And that was, I think, a Grubhub play or something. There was rumors Uber was going to buy them out. Can't remember, but it was pretty high, whatever it was. It was about 30% in one day. And yes, I've done some like morning penny stock trades and stuff, but I think the big thing is too, it's like, I mean, those were high risk, highly stressful, not steady, consistent ones. Because I'm just telling you the ones that I succeeded on. People might be like, oh, this guy's really good. It's like, well, hold on. Let me tell you about some of the really bad ones that went through, and then you're not going to be like, I need to follow this guy.
Yeah. You got to pick and choose.
I mean, yeah, I think the one thing I can say is that the mutual funds are really good for when people are unsure about whether they want to manage their portfolio, and you know, because something could be going up 20%, that 30% and everything like that. But I saw that crash down. I mean, I was one of the lucky ones to just sell out beforehand, and you know, you have some people that are holding on for too long, and I think that's the one thing though. If they have long-term goals, it makes more sense to go through somebody like you rather than managing their own stuff, because usually that's I mean, I've had like, I think my favorite thing was when the stock market was really hot was I was going to a store to buy some stuff, and I just went on my trading app, basically. It wasn't Wealthsimple, different one, but and I was like, you know what? I'm going to buy this stock real quick, and then I'm going to see what I make in half an hour, and whatever I make, I'm going to go spend it. And you know, it worked at that time, but at the same time, I've had some long-term ones too that I was managing that did absolutely poorly because they just didn't move, or they were just bad investments. And I think the problem is too, sometimes with that example, I might have been too stuck in that, like the winner that I had that morning. You know, I made that money so quick, but it was really a very small sum for how much I had to actually put in, versus if I just put that money into something that was a little bit safer. I think that's you know, we have this cognitive bias a lot of the times when we do it ourselves, versus when I look at the mutual funds, I'm like, well, 40%, shit, that's really good. Like I like that. That's steady, safe, and I mean, it's on a risky portfolio too, but at least it's steadily increasing, and I've got some faith in it. So for long-term planning, great. For the walking around money, like, yeah, I have been able to have some really good days where I could get my budget for the shopping spree in the day, but at the same time, there are some ones where I think you know, they just weren't doing very well that day either. I just wasn't looking at those ones.
Yeah.
But that being said, actually, moving on to with all this investments and with making money, assuming you do, can you just tell us a little bit about because you told me this term, I wasn't familiar with this at all, but the power of tax me never and tax me later accounts.
So it boils down to the long-term planning too, because you can have the same mutual fund and ETF and have it something in an unregistered account, whereas I mean, yeah, it's diversified, it's its own portfolio, but the crappy thing is that you're basically liable for the tax that's grown within the non-registered account. Versus something that's registered, like an RRSP, as TFSA, that's like the best way to really use it. Why I say tax me later, tax me never, is that with RSPs, it's considered to be more of a tax me later account. Why is that? Because money that's obviously grown in an RSP in the account itself is that if you see $10,000 grow to $11,000, the tax is not necessarily growth, but only at the time of withdrawal, and it's treated as income. So it's really beneficial to use an RSP strictly meant for the sake of retirement, and obviously for the sake of if you're making a high income. And notice the fact that in the month of February is technically RSP season, right?
Yes.
Because it's so beneficial for someone that's like, the people that are watching this right now, or just someone out there, that if you're making $50,000 to $100,000 at least, that's your an RSP contributing to the plan is your best friend, because every contribution that goes into the RSP is considered to be tax deductible, and every time that they deduct from your current tax is a potential to increase your refund. And there's an actual calculator that calculates that through TurboTax to show if you're making 50K, how much tax you pay, how much you would get your refund, and the difference in terms of actually getting more for your tax refund in terms of contributing it, right? So that's the benefit of RSP itself. TFSA is a little bit more universal. It could be used either towards retirement or before retirement, preferably even before retirement, like things such as like saving for a house, saving for saving for a wedding, saving for even for children's education, right? Beauty of it is that obviously tax is not necessarily growth, but the time that you withdraw out of the account, it's also not tax. So that's why I call it TFSA, tax me never account.
Gotcha. Yeah, because I know for tax-free savings account, which I think for the U.S. are called IRAs, something registered accounts.
Roth IRAs. It's either Roth IRAs or IRA or 401k. It's like usually like those type of plans, so similar towards like what we have here in Canada.
Yeah, I think a lot of companies switched to 401ks. They used to have like better pension plans, but the 401ks now exist, which I don't think they're as good as usual pension plans were. But that's I guess something else overall. But I mean, Canada's, when you have your own tax-free savings account, the nice thing is when you take that money out, no matter how much profit is gained from there, you get to keep that without being taxed. Is that correct?
Correct.
Yeah. So I know, like I do have tax-free savings accounts, and they're doing fairly well. But I usually use those more strategically to, I have dug into them a few times, which was naughty, slap on the hand for me for doing that. Desperate times called for desperate measures, but it was very nice having those at the same time. And I think it's very important that people kind of establish that sort of account because, I think a lot of people right now, especially with Wealthsimple and stuff, they are, I don't know if they offer tax-free savings accounts, but obviously you're not supposed to be day trading in those ones. I know a lot of people, like if you are over day trading in your tax-free savings account, CRA could actually constitute it as a regular account and tax you on it. I think that's the only way you can really break a tax-free savings.
Yeah.
You are allowed to manage your funds and everything like that. You're allowed to buy and you're allowed to sell. You're allowed to do what you need to do, but you're not allowed to like be in there doing 100 trades a day. So because I think that's the thing is a lot of people probably go, oh, tax-free savings account, I'm just going to get that because I don't have to pay tax, and then they do their 100 trades and then they realize like, oh, like maybe I shouldn't be doing that afterwards. I mean, I manage mine. And I do have mutual funds in another one that are just managed by somebody else. But I think that's a piece of advice that I think a lot of people aren't familiar with. And then, of course, there's people that are just passively investing in something that they want to hold for 20 years and putting it in a regular account when they should have it in a tax-free savings account.
Yeah.
And I think that's something that, which is nice to have somebody, an advisor or financial expert, at least manage that. Because if you have something that you're going to hold for that long, like, why would you want to pay taxes on it 20 years down the road? I don't want to pay taxes on it at all.
I show a really cool example every time I do presentations of like, if you're to invest like 10K each and every single year for 30 years at a 9% rate of return, like the projected return, if it was taxed, is at $825,000 versus something that's towards like a TFSA or RSP. It's like basically double that, like close to 1.5 million, right? Mm-hmm. And it's no brainer. Just like, what would you rather have? Like the 800,000, the 1.5 mil, right?
Of course.
So it's something that has those certain advantages, like obviously long term, and it's a bit really huge game changer in terms of what you want to accomplish too.
Yeah, and then I guess the other thing too would be to if you could just kind of explain too, like how contributions work, because I know like this is just for Canadian contributions, but how the contributions work for TFSAs and you know the limits and what happens when you take them out and how do you put more
So
in things like that.
RPs, they typically have uh, just to be safe, it's just around 27,000 for the year for the max that you can contribute in terms of like the as of like a recent tax year. Specifically, that's one calculation to calculate by for the RSP or 80% of your previous earned income, right? So if you made like 50,000, you basically times that by like 80%, and that's your ideal max contribution, not towards the actual max that's like reported within CRA, right? So that's one calculation for the RSP. With TFSAs, it's the beauty of it is just that if you were at least the age of 18 from two up until now, like the max of the contribution that you can put towards the TFSA for 60K. So that's the beauty of having it. If you have extra money lying around, you just want to keep it tax sheltered. In terms of how they're set up specifically, it's just that they work one and the same. You can either do a monthly pre-authorized checking like in terms of like putting away $2,500 each and every single month, or be able to do it in lump sum, right? Some accounts, some firms they do have like certain minimums, like they do minimum to put monthly away is like around 25 a month, and then minimum lump sum the first time start off is usually 500. Some firms they don't necessarily do that. I'm not to confused, but I think with Wealthsimple, I don't think they don't necessarily have those type of minimums, but they're very flexible accounts to really use in terms of if you're a first-time investor, fresh out of school, and don't have a lot of debt, and don't necessarily have a lot of money to invest, start off with that slow 25, 50, or even 100 a month.
Yeah, no, I think that's I think without the trading fees, I mean, I pay trading fees, so everyone calls me an idiot for it too, because my trading fees used to be $10. Now they're down to like $7, and a lot of people are like, "You're so stupid. You could be paying like $4.95, or you could be paying like pennies on it." I think one thing too, just to consider for a lot of people is understanding that. I'll bring up a calculator just in case people are wondering about it. But if you're inserting, like, Wealthsimple is good if you have like $100 and you just want to. There's no trading fees on it, so you put $100 in, and you gain $10 or whatever. You have 100 and you have 110, no trading fees, so $10 is your profit. Versus myself, if I put $100 in, well, it's $7, let's just say, to buy, and then $7 to sell. So at the time, if I have to make it's 0.14 time 14%. That's going to be 14% of a gain I have to make just to pay off the trading fees on a low amount, versus somebody that has nothing at all, which is a lot more convenient. So for me, 110 I'm still $4 short of actually paying the trading fee, so I haven't even made any profit at all. But if I have like $1,000, the trading fees are only like 1.4%, which is a lot more obtainable for a stock that's maybe gained 30% or 40% over a year or something like that, let's just say. So I think a lot of people might get hitched up on the trading fees, because some people, when they move from Wealthsimple, the one that actually has trading fees that are a bit more expensive, they might, and those add up. You do 100 trades, which I easily do within a year. That's $700 of trading fees alone. And that's really, really expensive. But at the same time, if I keep it low, if I put $10,000 in, let's see, 10,000, that's only like a 0.14% increase that I need. I don't even need a whole percentage point, basically. So I think that's the one thing too, is people don't realize to scale from their trading fees, if they do have it, to something else. Because then I think the big question is that a lot of people ask is, what's the minimum amount of money I need to invest? I don't know if like for me, active trading is different, but for you, what do you usually tell people?
I reverse the question, saying what's the minimum amount of money that you can afford. And I basically break it down like simple. Like if you want to start a lump sum, like if you want to start an account with either one of my firms I use, it's minimum lump sum 500. Minimum monthly is 25. and everybody's subjective, right? Like if they could afford like a healthy like $100 to $200 each every single month, I think that's a little bit more better than just doing 50 to 75. And anywhere if they were to do like at least lump sum on top of that, like 1,000 to 2,000 range or anything above that, right?
Mm-hmm.
If they're necessary to afford that, then yeah, like consider your overall budget. You got bills to pay, you got like things on the table too. So start like whatever works between that certain person, whatever they can really afford.
I think the nice thing too is when you do funds with financial advisors is that you aren't paying those trading fees every single time. So you're not paying, like for example, me, if I was to put in $25 every month, basically at the end I would have put in $300, but just to buy, if I was doing it on my trading platform, I mean, I'd already be paying $84 in trading fees alone, and I'd actually be down $84, and I would have only put in $216 instead. Which I think a lot of people sometimes go, oh, I don't want to like invest because then I got to pay trading fees, and versus with you guys, like it's different. On my perspective, my minimum amount would be, I probably do have more of a dollar amount in mind. I think from one person that I knew that used to do investments, he used to tell me that 1% was a good trading fee, basically. As long as it was 1%, that's the only time that they would actually invest. Otherwise, they wouldn't do it because it's just too high after that. It's eating away at what you want to save at. And assuming you're not trying to just day trade and everything and you want to save, I mean, you don't want to be paying that much in trading fees. 1% to 2%, yeah, sure, whatever. You're expected to gain way more than that later on. But I think that's one thing that is really nice, is just being able to set up your account, and then it just auto deposits or takes it out and then throws it into the funds that you have allotted to them, high risk, medium risk, whatever it is, and then they're able to basically just reap the benefits from that without having to, again, pay those trading fees, because that would just eat away at most people's, I think, savings if they're putting in, let's say, the minimum or the $50 to $75. That's, I mean, $7, even $5 of $75 is way too much of a fee.
Yeah, 100%.
That being said, we just moving on, or kind of segueing into the risk return and fees. Obviously, we kind of glossed over the fees, but tell us a little bit about on your end how risk return and the fees work usually.
So usually with return, that's pretty simple to understand. Is that what's that portfolio going to look like within their overall 10-year track record? I mean, with mutual funds and ETFs alone, like there's certain each portfolio has different returns per year. Like a 5-year return could be a lot higher than a 10-year return, or a 10-year return could be a lot higher than a 5-year return. But realistically, if they're really looking for long term, the one return that I typically look at is the return since inception. Otherwise, it's historical rating. Right, from the time that it's opened or the fund has been created up until now in 2021, that's the actual ideal North Star that I really look at for the return of what they're trying to accomplish, either 5, 10, 20 years, right? Risk is obviously being able to allocate based on the risk tolerance, if they're low, medium, or high. If I need to include like certain stocks in there, if I need to include certain bonds that would appeal to their current client. Another key trick that I really look at for mutual funds and ETFs specifically is looking at something called correlation and beta. So correlation and beta basically measures the overall, how well a portfolio can really handle risk. And simply said, the higher correlation or beta typically is, the more risk sensitive it is to likely to lose more money in a market fluctuation. The best description of having a very, very risk sensitive type of portfolio with a high beta correlation is like that one buddy that is very lightweight with alcohol. Takes one shot, party done, right? So yeah, obviously people don't necessarily want that in a certain situation, versus something that is a little bit more lower score, like for example, for beta, it scores at either like 1 or 2 or 3. If it's like 0.5 beta and it has a return of like 10% in 10 years versus the more higher comparison in the other portfolio, then it shows that not only it does well in the marketplace, but it doesn't fluctuate and lose as much money as any other portfolio. So in comparison to being the lightweight, being very risk tolerant, it's considered to be more of the heavyweight with the person with its alcohol, meaning the fact that if a market typically like hits or dips and it affects the portfolio, you won't necessarily see that much fluctuation.
No, that
And
yeah, definitely. I think that's a great way to put it. Actually, you mentioned ETF just because it seems to be relevant to well in the past day or two. If you can just explain the difference between well, just what an ETF is to people that aren't familiar, because I
so
know,
specifically
yeah,
with a ETF, it's basically a diversified portfolio where similar in terms of trading, you're able to do that in a more affordable way to do in terms of like choosing different types of like funds to trade into the actual fund itself. The one thing that with ETFs is that it tends to be a little bit more cheaper than mutual funds because in terms of actually instead of just having a physical portfolio manager that's doing his research and trying to beat like the S&P 500 or whatever index that the investment is performing at, typically with ETFs it doesn't necessarily try to beat it, it goes along with it. It follows a concept of passive management, right? So that's one basic way of explaining ETFs versus mutual funds. You're requiring actual human being to actually watch over the portfolio and he or she does his research the best to beat the market or beat the index.
yeah, I know the ETFs made kind of big news yesterday when silver went up.
Yeah,
There was the silver ETFs being what was it, SLV and SIVR and AGQ. They're actually down. AGQ being down 17.27%, which is absolutely
yeah,
insane after their little rocket upwards, which was, I mean, it was unnatural to begin with. It wasn't something that usually happens. Of course, I think the other thing too is there are inverse ETFs.
yeah.
And if you could just explain to people what an inverse ETF is too, because I know if people want to go into an ETF, they're going to want to know kind of why the inverse exists.
The inverse exists is just I think just to my knowledge is more in terms of the trading itself. That's kind of a curveball question for me personally. So I'm more of like in terms of just using mutual funds and actual ETFs actually.
Yeah, yeah. So I mean, yeah, I guess yeah, that's true. The inverse ETFs are definitely more for people that are day trading. You can trade an ETF like a stock. Basically, you can buy it. I know that inverse ETFs are usually they're leveraged. First of all, meaning using a lot
Yeah,
of money. There's a good amount of gain that you can get. So, for example, they usually go on the opposite side of the trade. So, versus having, let's just say, an ETF for corn, corn goes up. The regular ETF goes up, but if you have an inverse, it means that if corn prices go down, you have the inverse. You're gaining money off of the losses basically. So you're basically short selling almost
yeah.
without having to actually short sell.
Basically, right? So hey, again, if you have that appetite for risk and you had a little bit of skin in the game, then yeah, kudos to you. If you're more of just like set it and forget it, then something to really to consider as well, right?
Yeah, I mean, an inverse ETF is definitely not something that I would ever get into for like long-term investing because it doesn't work that way. It just it won't. You'd have the price has to go negative almost for it to be worth so much more. I mean, there's only so much that it can be not worth anything. Versus, I know there are some ETFs like people that are in gold, for example. That's long term, and yeah, you can stick in that. Or the S&P has their ETF, which just basically tracks how it's performing. And I mean, if you invested in that long time ago, well, you'd be up. And like there's ETFs for basically everything, but definitely, it is like what you said. You do have to manage it more yourself rather than a mutual fund. At least you have somebody that picked all 100 companies or however many is in an actual
Yeah.
fund for you, which is kind of much. I always prefer mutual funds over ETFs because ETFs just they bother me. They just really do bother me overall.
Oh wow, so that's pretty surprising fact for me too. It's just like, oh, it's for a person that actually manages portfolio. You actually don't really like ETFs. Okay.
I mean, the ETFs are again. It's you have to know what you're getting into because obviously you want to know what the ETF is leveraged and how much money's going into it, who's kind of put it all together. What is it even in, and the overall market. It's kind of a nice way to trade commodities without being in commodities because I know you can do oil, you can do gold, you can do. I think
Yeah.
there's cows. I don't know if that's still around, but I mean, I don't know enough about these. I don't have knowledge on cows. I've got more knowledge on individual companies like chip makers and esport companies and stuff like that. But I think
A fun,
ETFs are yeah.
yeah. A funny fact, and it's totally unrelated. In my culture, the Philippines, like we actually invest in goats, physical goats, like legit.
I mean, there you go. Wow, there ETF for goat. I'm sure there is. I'm sure there's a market where there's where there's a product, there's always a market for it, and where there's a market, there's gonna be probably stocks or something for it. I'm sure if I looked on, I guess it's, I don't know what the Asian markets are called, the Nikkei or something like that.
Yeah.
I can't remember, but I'm sure that there's goat investment probably in there. You could probably invest in goats.
The simple concept is just that you find like a mother goat and raises a couple kids and just sell it to like other people, and then they just get your cut out of it. And as long as they're producing and it lasts long, then that's their so-called investment in the farm world.
Yeah, no, that makes sense, and I guess that segues into basically talking about diversification. 'Cause we just did kind of browse over, like there's tons of ETFs,
Yeah.
there's tons of stocks and understanding it, but I know there's a lot of people that they take that Simple app, or they take whatever Robinhood and stuff, they take their 10K or however amount it is, and they throw it all in one.
Yeah, what I've been noticing a lot, like again, like Simple, beautiful app, love like the movement and empowerment towards it. But the cases that I've been seeing where people have been trying to do DIY, sometimes is a little bit over diversified. And what happens with an over diversified portfolio is just that think of it like this water bottle, right? As much as I want to fill it up to the top, it's good enough. But if I fill it a little bit more, it tends to spill out. So basically, in this example of having an over diversified portfolio, that one, if you have like 10 or 20 different types of like ETFs or index funds in that certain like Simple app, one, it's too hard to track between the winners and losers. Two is just that much like the overflowing of the water bottles scenario, is just that you're possibly overweighting your portfolio, right? Meaning the fact that if you just kept 4 or 5 in there, then it would have like healthy like double-digit return versus maybe just watering the portfolio down, right? And just to show in light of that, like I've actually seen actual comparisons where I've only presented like 4 different types of mutual funds versus the client has like 10 different types of ETFs, and sometimes less is a little bit more in terms of that favor. It's still good to have some sort of diversification in terms of where your risk tolerance really is. If you're like low, if you should have bonds, if you should have stock, and making sure that they're actually in stable type of industries, like things into financial, things obviously to tech, things into towards, and be able to have like a certain pocket within those type of industries that is available towards the marketplace.
Do your clients usually tell you like, or do you usually see kind of what they diversify in if they are over diversifying? Like, do they all just throw it all into like different energy stocks or something, or is it all like they just pick and choose like energy, industrials, technology, basic materials, goats, cows, everything like that?
Yeah, minus the cows though. So in terms of that, basically because for them, I usually like send them a catalog each and every single month of like what mutual funds are available, and sometimes they reach out to me, or sometimes that they have like money coming up. It's sometimes or most of the times what I usually typically deal with like with my clients is that I just really tell them just to stay invested and stay the course. Like you know some portfolios that I have, like for one of my clients, they've been around for like 5 years. You know, it's basically the same portfolio. It's nothing too crazy. It's nothing too like as crazy as what's going on with GameStop. Same type of like what's invested within with different types of like banks in this mutual fund portfolio, type of healthcare companies and so forth, right? And really truthfully, the only time that if I really need to readjust that they're not overall happy with their overall portfolio. But for now, everything's been fine and dandy so far. I've built a good relationship with them, and I could test that like everything's simple from here.
No, I think that's very true, and I think that's the nice thing about mutual funds. I sound like I'm gushing over them, but they are a lot nicer because they are already diversified for you, but by somebody else. I mean, even for myself, you know, I have a professional trading brokerage thing. I guess you could say it's professional. It just buys and sells is what its main function is to do. But, you know, managing all of these accounts, you know, I'm managing 4 different accounts in different currencies and everything like that. And I think a good point was keeping track of your winners and losers. Yeah, I've had like excellent winners where they're like, let's say 13%, 20% on the day. But, you know, just yesterday I sold something for, let's say, 40% loss or something. But I think, too, that kind of goes back to people's biases, is almost kind of thinking like, oh, yeah, I'm doing really, really well. And I know, you know, as somebody that started out managing my own funds to begin with, you know, I usually admit to people like exactly what the strategy was. There was no strategy. I said, I'm going to take this amount of money, and I told myself I'm going to lose it. I am going to lose it. I'm going to lose every single penny. If I make bad trades all the way to the end of it, I will lose all of it. I don't care, because I really wanted to learn. But the problem was was, of course, I was losing it. And I did lose that initial amount that I put in. It was a significant amount. I'm able to pay it back and everything now. But I think, going in, a lot of people have overconfidence in it. Like for me, I'm like to say I didn't have any overconfidence. I said I'm going to lose it all. I committed myself to losing it all because I was pretty sure I was. But I learned a lot during that time versus people when they are trying to risk it all for their rent or whatever it is, and they think they're going to pay off their credit card with it. I mean, it's and then they all go into all one, or as you put, like they over diversify, and it's so hard to keep track of everything if you're not really paying attention to it. If you're all into energy, and energy like oil took a hit when the pandemic started, well, yeah, you're down all over the place. But at the same time, if you're over diversified, well, now you're taking losses here in oil, but you're also kind of up in, I don't know, let's say renewable energy, but you're also down in gold or whatever you've invested in. And then it just becomes like, am I winning or am I negative? Am I positive? Am I neutral?
You can't really choose between just like, am I winning, losing, or like in the middle? Like, you're really confused in that certain scenario. So, yeah.
I mean, yeah, that's, I think, the other thing. Yeah, a lot of people understand a diversified portfolio, but then I think a lot of people fear maybe mutual funds and ETFs just because they're not familiar with what it is. They're so used to owning stock rather than going into a mutual fund. So I feel like if they approached you and they're like, oh, mutual funds, I don't know anything about that. They sound boring, they sound lame, they sound like they don't make much return. Because I know that's what they say is they make slightly more. Like everybody wants to beat Warren Buffett. They make 140% trade and they're like, I beat Warren Buffett. It's like not.
To add on point with like mutual funds being boring, like even portfolio managers literally quoted from Fidelity, like from a guy by the name of Joel Tillinghast. He manages the Canadian large cap fund. His approach to investments is literally meant to be boring. It's literally meant to be boring. It's literally meant to just be easy in a certain sense. I mean, there is the thrill of like being able to like, I'm gonna go on and like trade this like one hot topic that I found out from my best friend and so forth. But nothing really beats the boring approach. If it's been around for a long time and it's working for a lot of people, then that's the best way to really look at it too.
I mean, consistent gains over losses that are just significant, like even slight losses over a certain amount of time. It goes the other way too. Let's say that 2% gain every single day. Well, imagine losing 2% every day. It goes the exact same inverse of you losing $10,000, $50,000, $100,000 of an account if that's happening every single day because you're you're just not skilled enough to predict the market, or you just don't have that skill set to hold on, or you're too emotional as somebody that's trading. I know that's a big thing too, is for me it's numbers.
One thing to really and people really start to realize that as much as there are numbers associated with investing, there's a lot of emotion towards it. Another famous portfolio manager from Fidelity by the name of Peter Lynch, he had an interview that was going on, and he quoted very, very simply that the most important organ to really have in investing isn't really the brain, it's more the gut, right? Just making sure that you have that gut reaction to prepare. If things are going to happen from like 2008 or what's going on in the market right now, do you have the gut to be able to sustain that loss, right? And that's something that's so important, that it is a game of emotions and be able to maintain risk.
Yeah, I can definitely correlate that with my experiences as well. I mean, I've just the other day I was talking with one of my friends and I was telling him, like, I'm sitting on a $500 loss right now. Like, it's down $500, and at the same time I just told him I really don't care. It's not that I don't care about the money being gone. It's just I was like, it'll be back. I'm certain. I knew I got in kind of a bit too late or a little bit too early, whatever the case might be. A lot of it's timing too. I guess actually that's something else I should bring up to you is understanding timing the market. When people are investing with an advisor, is there a bad time to usually go with them? Is there a bad time to put money in?
From my book of quotes, I react with this. It's not about timing the market, it's time in the market. And people realize that too. Just like, okay, good. Like the whole GameStop situation, Bitcoin is basically popping off. It's just like, it's the best time to buy right now and to hold on to it. But now we're seeing consistent negative downturns of what's going on, right? It's just that if there was, and I always say this, just that if there's ever going to be a crystal ball for someone to predict the best times to buy, everybody we know would be driving Lamborghinis right now, but that's not the case, right? So it's always important to understand that it really takes that time and patience to see gradual growth for wealth long term, right? It's just that like I'm not a guru in terms of identifying like the best times to buy the like great marketplace. I've seen healthy returns for my clients and even for myself, but you know, in terms of the answer of like the perfect time to really buy, there's really no answer the way I've seen it. It's about just sticking to your portfolio, making sure that you're making that constant $25, $50, $100 each and every single month, and just be able to understand the concept of something known as dollar cost averaging, where doesn't matter what time of the market really is, if it's either low or if it's either high, you still continuously purchase each and every single month for to be able to see consistent growth. The way that I be able to put that into perspective is just that if you're putting away $25, $50, $100 each and every single month or bi-weekly, it's no different than you going to the gym, right? If I go to the gym and they want a body of like Arnold Schwarzenegger, what's going to make me the most muscle? Is it just going to the gym every single week, or 4 or 5 times each and every single week? You start to realize and stuff. It's being able to be more consistent with your purchases, whether it be in a mutual fund ETF or doing your own or doing your DIY. Just making sure that you constantly participate, whether if it's gain or loss. It's the simple concept of buy low, sell high. Simple as that.
No, I think that's actually a great way of putting it too, because I know I have some investments that I bought in really high. I really shouldn't have bought them in really high, but at the same time, I didn't put that much in it. I'm going to buy in a little bit lower, and I know it's going to increase because usually, not always, but usually stocks that are pretty stable do increase over time in value, and especially with most people, like because they're investing in the long term. I mean, if you look at like Amazon, you could be like, oh, well, I could have bought it at like, back when it was, let's say $80 or something. It goes down to 75, and you're like, oh, I bought in at 85. It's like, yeah, but you're not cashing that out until, I don't know, let's say 5 years later when it exploded and now is worth like $1,000 a share or whatever it is. I think people get a little bit too caught up in that because they're just like, oh, I wish I got that dollar amount. And it's like, yeah, you missed out on some gains, but if you really can't time out the market, and even if you can, sometimes it goes the complete opposite way. I mean, I did one trade today even that I timed it out, and then I waited a little bit too long where there was profit. It turned into kind of break even, if anything. And then I think that's one thing that a lot of people think they can do and they overestimate is their ability to get in at the right time versus exactly what you just said is understanding that dollar averaging is that, yeah, you might not have got in at the right time, but if you're reinvesting into something for your future and not cashing out right away, well, then you don't have to worry about like that loss or anything like that, you know.
And it really boils down between the difference of actually just gambling or bullshit or versus actual like real investing, and that gradual slow progression of being able to see that, you know, that steady increase, whether if it's like somewhere between 5, 10, 20, or the healthy 40% that you're seeing each and every single year.
Yeah, I mean that's actually a perfect example too. Is you saying gambling, because I know I usually get flack for gambling, so to speak, just being on the market, but I have my methods and they seem to be working. Everyone has their own different methodology. Like people do the technicals, they have their as most people call it, like voodoo. Basically they just look at the charts and, you know, wave some incense on it and hope that it works, basically. But yeah, exactly. I mean, they just kind of everyone's got their different methodology, and I guess for some people it works, some people it doesn't. I know my methodology is probably different than everybody else's when you are individually investing. But if you have the skill and you have kind of a proven talent, then it's not. I like to say it's not gambling. It is really just, you know, I'm not going to the casino and just hoping that I'm going to win. It's like I usually have a fairly accurate method. I'd say even if I lose more times than I win, at least my gains are more than my losses all the time, which I think is kind of important that a lot of people don't realize. Some people think that if I just win a ton, I need to win like 90% of the time, which is never going to happen. I don't think I've ever gotten close to that. You know, a lot of people's lose ratio is always higher. And that's the thing is, you know, overconfidence in the market and everything. But at the same time, when you're gambling, you know, if you're going in there blindly, you're going to get burnt versus if you just have some advisement or you seek that professional guidance. It's definitely going to help you for your long-term goals, because I think the other aspect too, which is always nice, is that I'm sure a lot of your clients go, well, I don't really want to just make those tiny gains, right? Even though they exponentially increase, like
They do.
5 years later. I don't think actually that's actually something I want to bring up just before we kind of wrap it all up. Is can you just explain like the exponential gains that basically happen when you start early investing or at least saving versus just when people are getting their 5% returns every trade that they're trying to do and their losses.
Like, the best way for I like to I always like using analogies to describe things. It's just like it's the difference between eating fast food versus cooking your own food, or it's more natural, it's more holistic in that certain sense. Even example like for someone that I started off with just $200 each and every single month for almost 2 years ago, his portfolio as TFSA is literally just over $4,000 in less than like 2 years, and that just started with just basic putting away $200 a month into his terms of this portfolio that he felt was right for him, and basically going through this discussion, and throughout the period of time, from what I've seen from it, it's just that it literally the highest average that I've seen from that 2 years when I last sat down with them up until now, it's grown to a healthy 40% since inception, right? So you do see the gradual long-term return. It will come. You just gotta be patient, be able to have time in the market.
I think that's what a lot of people like. I was talking with one of my friends who's a bit younger, and I was just telling them, I was like, if I was you and I just invested, my God, would I have so much more money? But when I was young, I was taking it out. I even took out my my government pension and stuff like that too when I was working there. Which I mean, it wasn't worth a lot, but $2,000. I think it was $2,000. I don't know, don't quote me on that, but it was around there. I'm sure that would have been worth a lot more now had I kept it, but I needed the money at the time. But I think the big thing is just understanding, like, if you keep this money and it grows, this exponential, it does go down to that, if you make 2% a day or something, you're not making 2% a day in this case, but you are making, let's say, 2% even a month maybe or longer, something. Yeah. I'm not sure what the actual average percentages per like year or per month, but that does grow after 40 terms. When you're 18 and then you turn 60, 40 times that exponential average over time allows you to retire and actually have some sort of backup fund rather than just earning money.
Really, just to make it all sensitive, peace of mind is a big thing too, right? Instead of just saying like I'm gonna like dice it at this like 100 trades and so forth, it's just that you actually have a simple projection and potential game plan that will work in favor for you. Even if you waited out another year or 2 years or 5 years, you see that gradual growth.
Well, I guess on that point too. Just want to kind of add this one in because you'll know a bit better, but a lot of people are putting in money, but what would you say is the right amount of money for like whatever you're making? I don't know, 40,000, 80,000. What's the amount that people should be actually investing with?
For basic, it's either like for them it varies between 3 percentages that I usually play around with. 5% if they can't afford it out of their gross income each and every single month. 10% out of their just an average if they make like what 4,000 like $4,000 each and every single month, and times that by at least 10. So that's what they should put towards paying themselves. And if it just to increase the average just a little bit higher, like up to 15% for the basics for people that are typically starting out and they don't want to spend too much. Ideally, if people are able to afford it themselves, much like going to the FIRE movement that I mentioned from before, the goal is at least 30 to 50 at least, right? But if people can't necessarily afford that 30 to 50, or to gradually get in there. It's kind of like you going to a gym. Like I thought it's my first time going to the gym in like 5 years. I'm not gonna lift like Arnold Schwarzenegger weights. I'm gonna start with like the baby weights first, and then gradually increase from there, right? So maybe my budget could be afforded towards 5%. Maybe it could be afforded towards 10%, and or if I could really afford it, maybe it could be the 15 to 20. But it really boils down to just that what's the right percentage for you? What's the right percentage that you're able to stay consistent with and be able to stick with it and have that consistency?
I think too, that's a good point, because I know a lot of people like, what is your response to people that are like, well, I want my money now, like, like what's your argument against that? Because a lot of people are going to say like, well, I don't want to like give let's say they can even afford it and they're fine with affording it, but they're like, well, I don't want to give you like 30% at all. Like, why should I bother saving?
I mean, I basically point out, and if they really want to get into it and they're just so adamant about it, I'll just give them a choice. Like, hey, totally up to you if you want to go gung ho with like spending one in terms of what you have in terms of this overall investment. But think to things like that could run into an emergency, right? And then I'm not gonna be surprised with those type of people. It's just like, yeah, I may not be able to afford it, but this is all I got. And they're gonna blow the extra like $500 my budget each and every single month in this investment. But I know hard of hearts that they're gonna ask me literally down the road to either like decrease it or be able to like pull out. So it's really to understand again the whole KYC concept. Just understand is absolute affordability, making sure stick with it for a certain period of time. If you're good at doing the each and every single month, like maybe be able to gradually increase it step by step.
No, I think it's a great way of putting it, because I know I've been probably one of the annoying clients that is always like, I need a grand out, or I need a few thousand, and then the questions are always just like, why the hell do you need it? You're supposed to save this, and I was like, something stupid came up, I need I understand too. Like some people have issues. When I was working for I won't name the company, but basically it was a predatory loan company. I quit that job. I was not happy working there, and I can successfully say I was so bad at the job, I never made one successful loan, and thank God, because I would have felt bad. It was like 47% interest rate. I'm like, I thought complaining about credit card interest rate at 20% was high, but I was like 47%. Jeez, but I do know that a lot of people that came in were there for emergency funds. Like a lot of the times it was. And I could tell that they weren't lying to me, because they had really no reason to lie. They just said they wanted a loan, and I didn't have to ask. They would just tell me. And most of the time it was like for auto loans, or for like sometimes they had issues, like they got laid off and they just needed like the rental or something like that. And if they had the rainy day fund, I guess, because it was usually just one-time things. These are not things that are popping up all the time. It's understandable that these situations occur, and it's nice to have, I guess, that fun, especially if you're putting 30% away and then you're just like, oh, well, sucks, I got to go on my savings, but at least I have some, and I can at least get out of whatever situation I'm in, because that's you don't want to have to go to the loan companies or anything like that. It's your own money, and it's gained interest. At least there's something out of there. You put in 1,000, and let's say it made $100, 10% increase. At least you only need the 1,000. You still get to keep the 10%. At least you had some money. You basically loaned to yourself and made a profit, which I think a lot of people kind of need to get more into their heads, rather than just, and I get it. A lot of people that are young, they want money now. And I think that's... the
instant gratification era.
Yeah, I'm guilty of it too. I admit to people, like, yeah, I mean, I only got smart later on when I started realizing, money's actually more important than I thought it was. I knew it was important. Never doubted its importance, but it is extremely important to have more later too. Did I really need to take out pension funds? Did I really need to do all this stuff? I mean, at the time, yeah, but at the same time, I could have got the money somewhere else. I could have just done some other stuff, but I think that's important. But on that note, I think we basically covered mostly everything with pretty good overview of everything. Any last comments or anything like that, I guess, to add?
I think I gave all the knowledge that I need to. Just to stay the course. Know what goals you really want to look for. And even when it comes to choosing an advisor, it doesn't have to be me. It could be someone that you recommend. Make sure that they fall within your current needs and they're not trying to sell your product. That's the best advice they can really give. That they stick towards like what you expect, and they work with you, and they be able to build that trustworthy relationship to help you accomplish whatever goals and dreams that you have in mind.
Mm-hmm. Yeah, financial advisor is definitely an important part of most people's lives. Well, they should be, at least. I mean, they're managing your money. That's the most important piece for most people's lives. But that being said, I will add your socials and everything. I know, Brandon, you also do you're doing kind of a show, or like little segments, I think, on LinkedIn as well, that kind of give some financial information as well, in case people are looking for that. So I'll definitely add that. How often are you doing those little segments usually?
Those segments is just that like during the summertime and towards like before lockdown, I got the chance to film as much as I can with my editor and good people from our creative factory. So I'll praise for them. And like we be able to put it like each and every we just filmed for a day, and literally throughout the whole entire month or towards the year we drop that hour long like recording session and be able to diverse the different pieces each and every single month. So like because of lockdown, it's kind of hard just seeing them right now. So what they've been doing is just that any of my long videos that we tape on either investing, insurance, or eliminating debt, they start to take pieces of it and developing micro content for each of the week and developing to reels on like LinkedIn and then as well as on Instagram as well.
Awesome. So I'll definitely add those to the socials and everything like that. Obviously, this video will be available permanently on YouTube. So anybody who's checking it out, just check in the description. We'll have all that information for you. And checking Brandon out, you can always reach out to him if you are interested in doing any business or anything like that, or any sort of questions. He's the person to do it. I'm not. I just do the esports stocks observations. I don't know anything about managing people's money or anything like that. I'm trying to manage my own. So, I mean, you're doing a hell of a lot more than I can possibly do here. So, other than that, also on that note, my drink is empty. I need to get another one.
At the end of the show, then.
Exactly. Drinks are empty. End of show. I think that'll be a reoccurring theme. Basically, is when my drinks are empty, I need to go get another one. I gotta cut it. Get out of here. But I just want to thank everyone that watches this video, basically. And again, check Brandon out. He's got a lot of great content. So other than that, thank you so much for watching, and we'll catch you again on another Money and Market show. We'll have more guests, and perhaps Brandon will come back on. So other than that, have a great day.